Do you think that too big to fail banks pose a risk to the financial system?
Failure is an essential part of capitalism. These banks, these very, very large banks, have an immunity from failure that is massively unusual. When things go well, the bankers or the people who run those banks get a lot of upside. And when things go badly, the losses, all kinds of losses, are imposed on society and on the taxpayers. That's a fundamentally unfair and really stupid arrangement.
Our next guest is Simon Johnson, the 2024 co-winner of the Nobel Prize in Economics, along with Daron Acemoglu and James Robinson. According to the Nobel Prize press release, this year's laureates have demonstrated the importance of societal institutions for a country's prosperity. Societies with a poor rule of law and institutions that exploit the population do not generate growth or change for the better. So today's theme will be on their research and how our societies and economies will grow for the better in the future. Simon Johnson is also the professor of entrepreneurship at the MIT Sloan School of Management. He's a research associate at the National Bureau of Economic Research, and he's on the board of directors at Fannie Mae. He was also a former chief economist at the IMF and the co-author, along with Daron Acemoglu, of the book called Power and Progress, Our Thousand-Year Struggle Over Technology and Prosperity. Professor Johnson, welcome to the show. An honor to host you today.
My pleasure.
Let's talk about the financial sector. You have had experience working in the financial sector. Financial crisis brewing in the future for whatever reason that you may ascribe to. Is that on the horizon for you, Professor?
Well, I think the history of the past 300 years or so, David, is there's always a financial crisis looming somewhere, for good reasons and maybe for some really bad reasons. So being vigilant and watching out for it as an official and as investors is the smart approach.
The former chair of the FDIC, Sheila Bair, warned on October 30th that rising debt levels could trigger the next financial crisis. She writes, "Make no mistake, if we continue on this path, investors will eventually lose confidence in our debt. The change could be gradual or sudden, but the consequences will be painful no matter the pace." What's your response to this quote and the attitude towards debt overall?
Well, Sheila Bair is a very good friend of mine. We worked together closely on many issues for more than a decade. And I think she's right to be concerned about our loss of fiscal prudence in the US. But I have to say, David, I wrote a book called White House Burning, which was on these issues, came out about 12 years ago. And not many people wanted to engage with it. As long as there isn't the pressure from the financial markets, as long as the politicians don't feel there are consequences to massive tax cuts or whatever, they unfortunately do not take this issue seriously. So I'm glad that Sheila's warning people, but I'm not holding my breath for it to have an effect.
If you take a look at my screen here, Professor, let me just show you this chart from the FDIC website. This is showing quarterly losses, unrealized losses or gains on investment securities by U.S. banks, held maturity securities, and available for settlement securities, as you know. As you can see here, in early 2024, actually all throughout 2021 to 2024, have accumulated the largest unrealized losses since 2008. In fact, these losses on paper exceed that of 2007 and 2008. Is this a concern for you or not so much?
Well, it's definitely a concern. Obviously, this was a big issue when Silicon Valley Bank got into trouble.
Yeah,
and that was fairly early in your picture here. Sure, there could well be other shoes to drop. I do think we're more aware of this now. I do think that the regulators and supervisors are paying a lot more attention than they were before Silicon Valley Bank. But there's no question this is one of the problematic issues that we have to deal with in this part of the credit cycle.
Let's talk about the direction of interest rates and the Federal Reserve. Typically, in the past, when the Federal Reserve engages in an interest cutting cycle, which is to say some sort of monetary easing, does the financial sector see losses or gains from this cutting? Because presumably when interest rates rise, the net profit margins also expand. So could the opposite logic apply?
Yeah, I think it depends on context, David. I mean,
yeah.
It depends on what happens to deposit rates. It depends on how much gets passed through to consumers. I'm not sure, David, by the way, that I expect a big decline in long-term interest rates, because obviously long-term rates are supposed to be determined by the market, and they've been very low. They were very low, unusually and weirdly low for a decade before COVID. Then they got even lower. So a return to long-term rates that are not too much lower than what we have now would not massively surprise me. Obviously, short rates we are expecting to follow a quite a different profile, given the Fed's position and what they're trying to achieve.
Well, you actually sit on the board of directors of Fannie Mae. You've written a book on the 2008 financial crisis with James Kwan, 13 Bankers, the Wall Street Takeover, and the Next Financial Meltdown. In 2012, you wrote in the New York Times that after 2008, the lawmakers fixed the problems which led to the great financial crisis. I mean, that was kind of the question that you posed, and I'll ask you again once more. What about regulations? Do you think that lawmakers post 2008 with Dodd-Frank and perhaps some other regulations fixed the problem?
They certainly addressed the problem. And I think, David, to be completely fair to them and to be honest, they did a better job than I expected at the time. And I was involved in some of those discussions, at least around the periphery. So I'm impressed that the financial system has held up as well as it has since 2010. It doesn't mean that the problems have gone away forever. It doesn't mean there couldn't be issues either in the banking part of the financial sector or in the non-bank part. I think eternal vigilance is the key phrase here. But the Dodd-Frank reforms actually achieved much more than I expected that they would. So kudos to them.
Do you think that too big to fail banks pose a risk to the financial system in some extent? To some extent,
yes, I think too big to fail is a really dangerous pathology because when you are too big to fail, of course, you have an incentive not to be so cautious. Okay, maybe at certain moments in the cycle, when everyone remembers what happened last time, perhaps you are cautious. But at some point, somebody's going to say, look, the downside for us, the people who work at the bank, is pretty small. The downside for our people who lend us money is tiny or non-existent. There might be some downside for our shareholders, but we're looking out for ourselves as executives more than our shareholders. So I think those incentives, when you put them together, is not what you really want to have.
Well, you wrote before, too big to fail banks should be made smaller, preferably small enough to fail without causing global panic. Can you just elaborate on that quote? Why should they be made able to fail?
Well, I think capitalism is an essential part. Failure is an essential part of capitalism, David. I mean, in other sectors, in fact, I would say all other sectors of our economy, we're very tolerant of failure. And in the US economy in particular, corporate bankruptcy and other forms of debt restructuring supervised by courts, for example, is a pretty efficient process. And, when a company's in trouble, gets broken up, the assets are sold off to other people, and there's a continuity of business, if that makes sense, of course. These banks, these very, very large banks, there's only a handful of them, of course, in the United States, they're quite different, and they have an immunity from failure that is massively unusual. Some people call it lemon socialism, meaning that when things go well, the bankers or the people who run those banks get a lot of upside, and when things go badly, the losses, all kinds of losses, are imposed on society and on the taxpayers. That's a fundamentally unfair and really stupid arrangement.
It's a stupid arrangement in what sense? Because it doesn't comply with the laws of capitalism?
Yeah, well, that's for starters. Absolutely is not capitalism, right? No, but I think it's stupid primarily because you're encouraging the banks to take on risks that are excessive, inappropriate. Society doesn't need these guys to go crazy with credit default swaps then, or credit risk transfers now, or whatever the next problem will be. This is not. Finance is important. Finance is the lifeblood of the economy. I get that. I fully support that. I teach that in my classes. But you don't need people in these very large banks to have an incentive to minimize their capital levels, to maximize their leverage, to go out and take ridiculous amounts of risk so they can get a bigger bonus, and then stiff the taxpayer with the losses, and with a massive recession, best case scenario, or worse, when things go wrong.
Okay. What about the argument that regulators need to put into place some sort of bailout program when things do go awry or when there is a black swan financial crisis? The argument here, at least from the regulator's perspective, Professor, is that if they do not bail out some of these too big to fail banks, well, then there's going to be a ripple effect of liquidity crises going into other sectors of the economy. In other words, they're putting a stop on bleeding before it gets worse. What do you say to that?
Well, of course, that is exactly the logic behind too big to fail. And look, I've testified in favor of the Federal Reserve and its emergency powers to Congress, including to the House of Representatives earlier this year. And there weren't a lot of members of the Congress on the Republican side who were supporting me in that. But honestly, when bad things happen, you need to have an intervention by the central bank. But let's step back. Why do you have to step in? Why does the central bank have to provide this sort of support? It's because as you said, the damage, the spillover damage from the failure of a major financial institution to the real economy would be substantial. So why don't we break them up and have smaller banks that can fail? So when one of them goes down, you can let it go down. Now, we haven't done that in a long time. Silicon Valley Bank was only about $250 billion in total balance sheet, and we didn't let that fail. There was an extraordinary and, I think, unfortunate intervention, but it was for the same logic. People were afraid of the knock-on spillover effect. So I'm in favor of other measures that can be used to support the financial system at the same time as allowing Silicon Valley Bank to fail. So Sheila Bair and I, for example, were both arguing for the Transaction Account Guarantee Program, the TAG, which the FDIC used to be able to impose to protect all deposits and all other banks at the same time as losses being faced by people who were creditors of Silicon Valley Bank. But unfortunately, that's not the path that was taken.
Let's move on to talk about economic growth and some of the research that you've done. According to the MIT press release of your Nobel-winning work, it says here the long-term research collaboration between Acemoglu, Johnson, and Robinson, which extends back for more than 2 decades, has empirically demonstrated that democracies, which hold the rule of law and provide individual rights, have spurned greater economic activity over the last 500 years. Tell us more about your research findings, Professor.
So we spent a lot of time looking into deep history and trying to understand why some countries and some places have done so much better than others. And of course, the income disparities around the world today are shocking, 30 or 40 to 1 in some instances. And what we found consistently was that countries that have outperformed the others and outperformed the weakest are the ones that were able to build political voice, representation, and to link that with economic institutions, rule of law, equal access to opportunities, and of course, a well-run and properly regulated financial sector. That's also extremely helpful. So it's sort of the magic combination, David, of what you need for capitalism to function, which is opportunity for all and excessive power for hopefully no one.
Well, how would you explain the rise of economic growth and prosperity of several autocratic countries around the world? I hesitate to put China in that category. Perhaps it fits, but there are several examples of economies that aren't democracies that have grown tremendously. Have they not?
So you can always get lucky. You can find oil. You can have a good run. You can have a commodity boom. Sure, but plenty of that happens. Can you sustain growth? Can you build income per capita in a way that lasts through multiple cycles? That has proved much more challenging in autocratic places. And as with regard to China, David, I mean, the question I have for them, and I'm the former chief economist of the IMF. I have plenty of opportunity to talk to current or former officials, so I'm not saying anything to you haven't already said to them, is, if the Chinese economic success is so widespread, and if shared prosperity is really as reported by the authorities, why is it that when we look at the wages of unskilled workers in Japan and Korea during their economic miracles, they are flat for a while and then they boom and they go up, and Japan reached US levels and Korea had big increases. When we look at the same data series for China, it's flat from the 1980s until the 2010s, and then the data series is discontinued. And if you try to find out, David, what's in that data series in China, or Chinese economists, you get into serious trouble. So if the Chinese economic approach has delivered shared prosperity, why won't they share the data? I'm just asking for the data, David. I'm just asking for the same data we have from other countries, and they won't provide it.
The argument that democracies have done well over the past 500 years, is it just the democracies, the political system that have instigated growth, or is it because of the capitalism system that has been paired with the democracy that has been the biggest contributor to growth?
Yeah, I think if we come at it from the growth angle, but capitalism of this form, which is, equal opportunity for as many people as possible. That's the key, an even playing field, David. I think there's the term capitalism is a pretty descriptive term, and to me, it's not a pejorative. I actually like that term. But I think there are varieties of capitalism in the world, and some of them, Vladimir Putin's Russia has a lot of capitalism or capitalist elements, but it's fundamentally quite different from the United States or Canada, in large part because all of the power is in the hands of a few people. At this point, they're mostly in Mr. Putin's circle. So capitalism of the equal access variety is what you want for prosperity, and underpinning that with and developing alongside that democracy, equal voice, proper representation for everybody, that is the robust combination.
Theoretically speaking, if we were to have a democracy and pair that with a socialist system? Would that even be possible?
Well, I spent 10 years at the beginning of my career in Eastern Europe and the former Soviet Union, David, and I worked for the first Solidarity government in Poland. I worked with economic reformers in a variety of countries, including in Ukraine, by the way. And I think that the people I worked with who were very good people who wanted, economic freedom and political freedom for their people, they were very skeptical that maintaining that kind of socialism with a lot of power in the hands of the state was consistent with proper, vibrant democracy. And I think it's no mistake that it's not by mistake that the countries in that region that have done best, like Poland, are the ones that have moved towards a more West European style of capitalism and a more West European style of government and governance. It's not perfect. It's there's plenty of bumps, don't get me wrong, but I think that's the combination that they chose for themselves. And these are the people with some of the longest, most practical, and frankly most difficult experience with socialism as it has existed that we've had anywhere in the world in recent history.
If there is one economic system that maximizes growth and prosperity, which would it be?
So again, I'm going with the capitalist version that we have in the more democratic societies of Western Europe, North America, Australia, New Zealand. This form of capitalism, but the emphasis is on equal protection before the law, more opportunity for more people. And I understand that there's a lot of inequality in these places, and it's not the case that everybody has access to education or capital or the same work opportunities. So that's something we still need to work on. But I think those are the places, well, I know those are the places that have done best, and those are the places that have been able to sustain prosperity. And I think those are the places that remain, despite today's difficulties, the most likely to succeed.
If a country were to experience very high levels of inflation, or even in some cases hyperinflation, like we see today in Venezuela or Lebanon, what should be the appropriate policy? Is there a one-size-fit-all monetary or fiscal solution, or is it case dependent depending on the country?
So I wrote my thesis on hyperinflation. So that was my first deep topic in economic research. And I think when the inflation becomes high enough to be completely debilitating, like hyperinflation, you really that becomes bringing that down through fiscal consolidation by stopping the printing press through whatever means is absolutely essential. And eventually all hyperinflations end because they're so massively destructive. However, David, it's usually the case that hyperinflations do not occur by accident. So if you look at Germany in 1923, the Soviet Union in the 1920s, or Venezuela today, there's clearly deep political problems that are being not addressed and but still manifest in through the printing of money. And I think you need to get past those problems one way or another in order to be able to bring the budget under control.
If, let's say, a country were experiencing hyperinflation, should they anchor their currency to another currency, such as dollarization, for example, where should they return to a gold standard of sorts, anchoring it to a commodity? Would those be appropriate options?
Everything's on the table, and a lot of times it depends on what the IMF will support, because having some external financing is going to be very helpful. I think that the IMF is going to focus on credible fiscal accounts first and foremost. Sometimes an anchor or fixing the exchange rate can be helpful, depending on how the domestic population is thinking about value and how they're thinking about inflation. But of course, you've got to be careful, because if you fix the exchange rate too early or at the wrong rate, you can very quickly become uncompetitive, and that can damage the sustainability of the policies. See Argentine recent history for details, right? So I think you need to be practical and pragmatic about it. And it's not one size fits all when it comes to the precise approach or the means that are used, but you do need to bring the inflation down.
Do you think that the U.S. will, in the next administration, see inflation return to 9%, which was the peak in 2022? Is that in the cards, you think?
I mean, I do think Mr. Trump's rhetoric around the Federal Reserve is extremely worrying. I mean, the point of having an independent central bank is precisely that it is insulated from political pressure, because the politicians usually want to juice the economy when there's an election or something else going on, and juicing the economy without the constraint of professional expertise and an independent central bank will tend to push inflation up towards 10%. So I think there's plenty in Mr. Trump's rhetoric to make one worry about future inflation.
Both President Donald Trump and Vice President Kamala Harris intend to use tariff policies to some extent. I mean, as you know, the Biden administration didn't get rid of the Trump tariffs, and candidate Trump has actually, on the campaign trail, said that he wants to double down on tariffs in many instances. What is your general attitude towards tariffs in achieving any sort of economic goal? Do they work?
So I've studied Mr. Trump's proposals very carefully and actually wrote a column that just went live right now in Project Syndicate making this assessment because while you were correct in exactly what you said, I think the way you said about the Biden administration was spot on. And I do think that using tariffs in some contexts is appropriate, including, if you feel that your major trading partners are subsidizing one way or another their exports. Mr. Trump's proposal is actually goes a lot further than what he did before and what the Biden administration has implemented. And the really striking thing, of course, about the Trump proposal is it would be a massive tax on lower income Americans because many lower income Americans have a very high import content of the consumption. If you buy a lot of goods from Walmart, just to pick on someone, but for example, then you're buying a lot of goods that have import content, and you can calculate the hit to people's income from such tariffs. So Mary Lovely and Kim Klausing have written a paper on this. I have nothing to do with this paper. It's their work, not mine, but I think it's admirable. They calculate a hit of something like $3,000 a year equivalent on the bottom decile, the lowest 10% of Americans, if Mr. Trump would implement his plan. That's a huge hit. And actually, I think Mr. Trump would not be able to do anything like that because these people would be absolutely in an uproar for good reason. And many of them support Mr. Trump. So they would be extremely disappointed with him. I think that his tariff proposals are at best paper tiger or empty promises. But of course, President of the United States does have a lot of power in the trade sphere and can start a trade war. Let's be very clear. So Mr. Trump could do enormously damaging things with regard to protectionism.
Well, what about the idea of eliminating income taxes and supplementing that revenue stream with tariffs? On the surface, it sounds great. Nobody likes to pay taxes, but would that work?
Well, first of all, tariffs are a tax on your own consumers. All right. Mr. Trump is completely wrong when he denies the opposite. Talk to anybody who's lived in a country with tariffs, and they'll tell you how that is. Secondly, it's a ludicrous fantasy because the numbers just don't add up. You cannot possibly generate in the modern economy anywhere near enough revenue from tariffs to replace income taxes, unless you're going to be basically shutting down imports. But hey, if you shut down imports, you don't have any tariff revenue, do you? Because imports are now so expensive. The whole thing, David, makes no sense whatsoever. But when did that ever stop Mr. Trump?
Last question, Professor Johnson, before we go. In your opinion, which fiscal and or monetary policies need to be implemented and or changed in the next 4 years to maximize prosperity for Americans?
Well, I think you need to bring debt to GDP down, and that's my interpretation of the right way to sort of address the Sheila Bair critique and concern. And the way to do that is not to cut taxes right now. Is when the economy booms, you want to bring in the revenue. I do think edging the corporate income tax back up and removing or not extending the tax cuts for very rich Americans who are, after all, already very rich. I think that's the right approach, David. Not too radical, and over time, the fiscal consolidation would take place, so you're not going to disrupt the economy. It's entirely feasible. Okay, it doesn't grab the headlines when you say it, but I think a moderate, sensible approach like that is the right way to go.
Thank you very much, Mr. Johnson. Where can we learn more about you and your work and follow you?
So we have a research group at MIT called Shaping the Future of Work, and we have a web page there, and we have a policy paper about how to create more pro-worker AI, and a lot of work, applications of our research and explanations of the various things that we've been talking about today, David.
And your book that you've co-authored with Mr. Asmaglu, can you just give us a synopsis of that book and what we can expect to learn?
Yeah, so the book's called Power and Progress, Our 1,000-Year Struggle Over Technology and Prosperity. And it's basically the backstory for ChatGPT, David. So we're looking at all the previous major transformations of technology. And as one of my colleagues very kindly quoted from the book recently, the point is, we want improvements in technology. We need technological progress, but don't assume that just because machines become more productive or algorithms can now talk to you, don't presume that will necessarily help everyone. It can, it should, we can make that happen, but not on autopilot. On autopilot, what happens is a few people get really rich and they boss you around and tell you that things have to be as they want, and the rest of you stay on very low wages. Don't buy that. That's what our book's about, is empowering people to understand we can get better outcomes out of improvements in technology, including the artificial intelligence revolution currently underway.
Thanks very much. Put the links down below. Stay tuned for more, and I look forward to catching up with you again, Professor Johnson. Take care.
Thank you. Bye-bye.